For years, the smartest people on Wall Street said the same thing about Michael Saylor. Not that he was wrong about Bitcoin, that he was wrong about the math. They said the debt would catch up to him. They said the dividends would catch up to him. They said one day, the man who told the world he would never sell a single coin would have no choice. And 3 months ago, that day actually came. Strategy sold Bitcoin. For the first time in 4 years, they let some go. But here's the part almost nobody's talking about. What happened right after that sale may be more important than the sale itself. Because 11 days ago, Strategy didn't quietly hope investors would forget. They stood up, rewired their entire financial structure in public, and dared the market to keep doubting them. Stay with me until the end, because what I'm about to show you is not just a story about one company. It's a preview of what happens when the oldest rules of corporate finance meet an asset nobody fully understands yet. Quick note before we go further. This is not financial advice. I'm not telling you to buy anything, sell anything, or copy anyone. I'm walking you through what actually happened in plain language so you can think about it clearly. What you do with that is up to you. All right, let's go back to the beginning because you need to understand why so many smart people thought this would end in disaster. Wall Street wasn't guessing. They weren't asking if, they were asking when. When would Michael Saylor be forced to sell Bitcoin? That was the thesis, not a hot take, not a fringe opinion, a working assumption held by serious analysts at serious firms. Here's why they believed it. Strategy, the company most people still call MicroStrategy, didn't buy Bitcoin with spare cash sitting in a corporate account. They bought it with borrowed money, with convertible debt, and eventually with something more unusual, a stack of preferred stock offerings, each one promising investors a fixed, attractive dividend in exchange for their capital. By the middle of this year, that stack included 5 different preferred securities, each with its own ticker, its own yield, its own promises. The company kept raising fresh capital, kept buying more coins, and kept doing it again and again. The bears weren't stupid. They looked at that pattern and asked a simple question. What happens when the market stops handing you money? So what changed? Hold that thought. Let's make this simple, because the mechanics matter more than the jargon. Picture owning rental properties. Instead of paying down a mortgage over time, imagine you're refinancing constantly, pulling fresh capital out again and again to buy the next property. It works beautifully as long as lenders keep saying yes. That's roughly what Strategy was doing, except instead of banks, their lenders were public market investors, buying convertible debt, buying preferred shares, and buying common stock through ongoing offerings. For a long stretch, this worked because Strategy's stock traded at a premium to the actual value of the Bitcoin it held. Investors weren't just buying Bitcoin exposure, they were paying extra for it because they believed in the model. That premium was the engine. Sell shares above the value of your holdings. Use the proceeds to buy more Bitcoin, and the value per share goes up. Repeat. But premiums don't last forever, and when a premium shrinks or disappears, both of your capital taps, the stock and the preferred shares, get harder to turn at the same time. So here's the question that quietly haunted this company for years. What happens if the capital markets simply close? Keep that in your mind. We're about to watch it happen in real time. Let's break down the actual pieces of this capital stack, because the names sound confusing on purpose. There's convertible debt, which lets Strategy borrow money that can later convert into shares. There's preferred stock, which pays a fixed dividend, but doesn't carry voting power the way common stock does. And there's what's called an at-the-market offering, or ATM, which lets a company sell new shares gradually, directly into the open market, rather than in one large batch. Each of these tools does something slightly different. Convertible debt is cheaper, but adds future dilution risk. Preferred stock is more expensive because of the dividend, but doesn't dilute ownership the same way. ATM offerings are flexible, but they depend entirely on investor appetite in that exact moment. Strategy used all 3, layered on top of each other, for years. And for years, it worked because each new offering was met with enough demand to fund the next Bitcoin purchase. But that only works in one direction. It assumes each new offering will be met with the same enthusiasm as the last one. Nobody built a version of this model for what happens when that enthusiasm cools. Now here's the part almost nobody was paying attention to. This wasn't a hypothetical stress test anymore. Between the start of this year and the end of June, the annual dividend obligations across Strategy's preferred stock stack, that's STRC, along with STRK, STRF, STRD, and STRE, quadrupled. They went from roughly $300 million a year to about $1.2 billion a year in 6 months. That's not a rounding error. That's a company whose fixed obligations grew 4 times faster than its ability to comfortably cover them. So let's actually talk about STRC, because this is where the story gets interesting. STRC, nicknamed Stretch, launched last July. It's a perpetual preferred stock, meaning it doesn't have a maturity date the way a bond does. It was designed to trade around $100 a share, and in exchange for buying in, investors would receive a high, steady dividend paid every 2 weeks. Here's the pitch. In Saylor's own framing at the time, he told investors he was giving them the upside of Bitcoin exposure without the downside, plus a dividend while they waited to get rich. That's a bold promise. And for a while, it worked exactly as designed. Why did this matter so much? Because it opened a door that plain Bitcoin buying never could. Instead of only attracting believers who wanted direct Bitcoin exposure, Strategy could now attract an entirely different pool of capital. Income investors, funds looking for yield, retirees looking for steady payouts. People who didn't necessarily believe in Bitcoin at all. They believed in 11.5%. That's a completely different customer and a completely different capital pool. This is exactly why this matters right now, because the moment your funding model depends on people who are chasing yield rather than believing in your thesis, your risk profile changes completely. Yield investors don't hold through chaos, they hold through calm. For the first several months, this looked like genuine financial innovation. Not because STRC bought Bitcoin directly, it didn't have to. What mattered was how it changed the way Strategy raised money in the first place. Instead of relying purely on convertible debt or diluting common shareholders through constant stock sales, Strategy now had a third lever, one that, in theory, gave it more flexibility, deeper cash reserves, and a longer runway before it needed to touch its actual Bitcoin holdings. That's the story Wall Street wanted to believe. A company reducing its dependence on any single financing method, a more resilient capital structure. But critics still weren't convinced. And by early summer, we found out why. Let's not strawman the bears here. Their case was strong, and by June, it was playing out almost exactly the way they predicted. Bitcoin's price fell. Not catastrophically, but meaningfully, dropping from levels above $90,000 earlier in the year to roughly $58,000 by late June. Strategy's average cost basis across its holdings sits close to $75,000 a coin. Do that math, and you'll see the company was sitting on a real uncomfortable gap between what it paid and what the market said its coins were worth. At the same time, those dividend obligations kept coming due, every 2 weeks, like clockwork, regardless of what Bitcoin was doing. Cash reserves fell by roughly 38% over the course of the year. Dividend coverage, meaning how many months the company could pay its preferred obligations using cash on hand, compressed from a level analysts once described as over 7 years, down to about 14 months. 14 months. That's not a comfortable cushion anymore. That's a countdown clock. And then, in late May, it happened. Strategy sold 32 Bitcoin. A tiny amount in the context of a company holding over 800,000 coins, but symbolically enormous. It was the company's first disclosed net Bitcoin sale in 4 years, and the proceeds, roughly $2.5 million, went straight toward funding the STRC dividend. The man who built his entire public identity around never selling sold. STRC itself felt the pressure directly. In mid-June, its price dropped to an all-time low of $83, eventually closing a session at $88, the first time it had ever traded below its original $90 offering price. MSTR, the common stock, fell to a 52-week low around the same time, down more than 80% from its all-time peak, and down roughly 28% for the year. A research firm called CryptoQuant published a note that week. Their message was blunt. Strategy needed to pause its Bitcoin purchases entirely and rebuild its cash reserve to around $2.8 billion, enough to cover roughly 2 years of obligations before resuming any buying at all. So when the market watched all of this unfold, the honest question wasn't, are the bears wrong? The honest question was, how does a company respond when its own model starts working against it in real time? Are you positioned for this kind of volatility, or are you just watching it happen from the sidelines? That's worth sitting with for a second. There's a detail here worth slowing down on, because it says something about how Saylor himself was framing all of this, months before the stress became public. Back in April, at a Bitcoin conference in Las Vegas, he described STRC not as a Bitcoin product at all, but as digital credit. He was already talking, in April, about the possibility that the company might need to liquidate some of its holdings by the end of this year to manage cash reserves. That's worth pausing on. This wasn't a surprise reaction to a crisis. The language was already shifting before the crisis fully hit the headlines, which raises an uncomfortable possibility that this wasn't a company caught off guard, so much as a company that saw the pressure building and started preparing the market for it in advance. Here's where this story stops being predictable. On June 29th, Strategy didn't hide from the pressure. They didn't quietly ride it out and hope for a Bitcoin rally to bail them out. They announced something they called a digital credit capital framework. And it's worth understanding exactly what's inside it, because this is the actual pivot point of the entire story. 4 pieces. First, a formal US dollar reserve policy. a structured commitment to maintaining cash reserves specifically to cover preferred dividend obligations, rather than treating cash as an afterthought. Second, they raised the STRC dividend itself from 11.5% up to 12%. That might sound backwards, raising the cost of your own obligations while you're under pressure, but it's a signal. It's strategy telling the market, we will pay whatever it takes to keep this instrument credible. Third, they authorized up to $1 billion in buybacks for their preferred securities, and a separate $1 billion in common stock buybacks. Neither program obligates them to actually spend that money, but the authorization itself is a message aimed directly at the investors who'd started to doubt the structure. And fourth, the part that matters most, a formal Bitcoin monetization program. Not a one-time emergency sale like the 32 coins in May, an actual structured ongoing mechanism for converting portions of Bitcoin holdings into cash when needed to protect the credit quality of the preferred stack. Michael Saylor's own words when this was announced, strategy remains committed to Bitcoin as its primary treasury reserve asset, but digital credit requires liquidity, discipline, and active capital management. Read that again. This is the same man who spent years building a public reputation on the idea of never selling. Now he's telling investors, in a formal corporate filing, that active management of Bitcoin holdings is part of the plan going forward. This is where things start to break down, or start to make sense, depending on how you look at it. Because maybe the critics who said he'll be forced to sell eventually weren't entirely wrong. But maybe they were wrong about what that would mean. A forced, panicked liquidation is one story. A structured, disclosed, board-approved monetization framework is a very different one. Comment below if you think that distinction actually matters, or if a sale is a sale no matter how it's packaged. Here's what smart money is already starting to think about, and it has almost nothing to do with Michael Saylor personally. Strategy was the first major public company to build its entire treasury strategy around Bitcoin. Whether this current framework succeeds or struggles, it has already proven something important. There is now a real, tested playbook with real public data showing exactly what happens when a company tries this, the successes, the stress points, the exact moment things get uncomfortable, and the exact tools available to respond. Now ask yourself the question that actually matters. What happens if other companies study this playbook? Not to copy it recklessly, but to learn from both halves of the story, the upside during the good years, and the stress test we just watched unfold in real time. Every public company with cash sitting on a balance sheet now has more information than it did 18 months ago about what this path actually looks like, warts and all. That's not hype. That's just data becoming available. Think about what a corporate treasurer at a completely unrelated company now has access to. They can see exactly how fast dividend obligations can compound when you layer multiple preferred instruments on top of each other. They can see exactly how much cash coverage matters and how quickly a 14-month runway can start to feel uncomfortably short. They can see how markets respond, in real time, to a public monetization framework versus a quiet, unexplained sale. None of that existed as a real-world case study 3 years ago. It exists now because one company was willing to run the experiment in public under enormous scrutiny, with real money and real consequences attached to every decision. This is where the story changes from one company's experiment to a case study everyone else gets to learn from for free. Here's a question worth sitting with. If you were advising a company with several $100 million in idle cash sitting on its balance sheet today, earning very little in a low-yield environment, would this case study make you more cautious about an allocation like this? Or would it actually make you feel more prepared to attempt a smaller, more disciplined version of it? I'm not going to sit here and tell you Bitcoin is guaranteed to go anywhere in particular. Nobody honest can tell you that. But here's what's genuinely worth thinking about. If more companies start treating Bitcoin as a treasury asset, even cautiously, even at small allocations, the way large pools of capital interact with it starts to shift. It stops being purely a retail trading instrument moved by sentiment and social media. It starts becoming something closer to a corporate balance sheet asset, sitting alongside cash and short-term securities. That shift, if it happens, doesn't happen because of hype. It happens because of frameworks like the one we just walked through. Messy, tested, publicly disclosed, and refined in real conditions rather than in theory. Do you think the broader system can hold if more companies attempt versions of this? That's a genuinely open question, and it's one worth having an opinion on before it's the headline instead of the preview. Let's be honest about the piece of this that no capital framework can fix. Everything. Strategy just announced assumes a certain level of stability in the broader financial system. Interest rates, credit spreads, overall market liquidity. If the Federal Reserve tightens conditions further, if credit markets broadly become more cautious, or if there's a wider macro slowdown, none of Strategy's internal restructuring changes the external environment they're operating in. A company can build the most disciplined internal framework in the world, and it still can't out-execute a genuine liquidity crunch across the entire financial system. That risk sits above any single company's balance sheet decisions, and it's the one variable this entire story can't fully control for. This is the honest, unglamorous truth sitting underneath an otherwise dramatic story. Good planning reduces risk. It doesn't eliminate the risk that comes from outside your own walls. Let's go back to where we started. Wall Street believed Michael Saylor would eventually be forced to sell Bitcoin, and that this would be proof his entire strategy had failed. Here's the twist. He did sell. Just not the way anyone predicted. Not in a panic, not in silence. In a formal, structured, publicly disclosed framework with a higher dividend commitment, buyback authorizations, and a dollar reserve policy attached to it. Maybe the mistake critics made wasn't in predicting the sale. Maybe it was in assuming the sale would be the end of the story instead of a chapter in it. Because here's the real open loop this entire video has been building toward. Maybe Saylor was never purely trying to build a Bitcoin hoarding company in the first place. Maybe what he's actually been building, slowly and expensively and under enormous public scrutiny, is something closer to the first real Bitcoin-backed credit market, one with dividends, buybacks, reserve policies, and monetization tools that look a lot more like traditional corporate finance than most people expected. Whether that experiment ultimately succeeds is genuinely unknown. The stress this summer was real. The 14-month coverage window is real. The risk sitting above all of it in the broader macro environment is real too. History rarely looks obvious while it's still unfolding. When Amazon stock lost most of its value in the early 2000s, most people assumed the entire internet retail experiment had failed. When exchange-traded funds first launched decades ago, almost nobody imagined they'd eventually become one of the largest categories of investment vehicles in the world. Today, the question circulating around this story isn't, can Michael Saylor keep buying Bitcoin? That question, honestly, might already be outdated. The real question being asked in boardrooms right now is different. What happens if more companies study exactly what strategy just went through and try a more cautious version of it themselves? Because if this digital credit capital framework represents an early, messy blueprint, the successes and the stress points both included, then the next chapter of this story won't be written by retail traders watching candlestick charts. It'll be written in corporate finance departments by people deciding what belongs on a balance sheet. And that quietly might end up being the bigger story all along. What would you do if more companies actually start walking this path? Are you tracking this shift or letting it pass by unnoticed? If this breakdown helped this make sense, hit like. It genuinely helps this channel reach more people trying to understand what's actually happening, instead of just reacting to headlines. Subscribe if you want to stay ahead of stories like this before they become mainstream news. And if you know someone who owns strategy shares, STRC, or Bitcoin directly, someone who might be watching headlines without understanding the mechanics underneath them, send this to them. Understanding the structure now is worth more than reacting to it later. One last thing before you go. Morning, afternoon, or night. For you right now, drop it in the comments. I like knowing where in the world this is landing. This is the Wealth Continuum. We'll see you in the next one.